Hello and welcome to Moving Iron Tax Moves with Glen Birnbaum. Glen, it's that time of the year again where you've got to do your quarterly estimates. So talk about that a little bit and what else you see happening out there.
Yeah, so normally our estimates are on the 15th of the month, September 15th. This year it's actually going to be Monday, September 17th. So you still do have some time if you haven't made your quarterly estimated tax payment. Now, we've talked about this a little bit in some past podcasts, but just as a reminder, farmers do have some special rules. Generally speaking, farmers, you only really have to make one payment. January 15th estimate is all you really have to make. Possibly even better than that, you can not make any estimates and then just file your tax return by March 1st. So you may remember that. But for others, the people maybe that aren't farmers, you do have to make these quarterly estimates. Generally speaking, the rule is you have to pay 90% of what you think your tax is going to be. Your actual 2018 tax, 90%, or 100% of 2017's tax. So 100% of the prior year tax, and it's the smaller of the two. So generally, you're supposed to estimate that, pay it in every quarter. Now, obviously, withholding of wages, for people that are employees, that's being done, weekly, monthly, whatever it might be. But if you're self-employed, if you have your own business, you got to cover your business income, and that's what you need to make these quarterly payments. Now, the rules are a little bit complicated. If you want to get a little bit fancy, as we might say here, is generally speaking, you just pay it in equally, right, over the 4 quarterly payments, pay them in equally. But if your business is seasonal, you don't have to do that. You would look at your quarterly income and then pay it in based on that. Now, because September 15th, the quarter's actually not completed yet, right? So you actually, if you want to kind of just look at your actual income, you would just look at your profit through August is how you would do it. So, you would basically, if you're running a business and you talk to your tax accountant and you say, hey, I didn't make any money, from January 1st to August 31st, you can kind of reasonably show that on your books and records, then you actually don't owe any estimated payment, right? Maybe you make a lot of money in December, but you really can if you want to. There's a special form you have to fill out to kind of show that to the IRS, because otherwise they will charge you interest. But if you can show, hey, I didn't make any money from January 1st through August 31st here, no payment would be due. So do keep that in mind. The other thing is, okay, what if I'm not making my payments? The IRS charges you a 5% annual interest rate right now. That rate does change every quarter, but it is 5%. So it's not a terrible rate. It's not real high. The thing to keep in mind, though, is that this 5% interest is not tax deductible, right? If you're paying interest to your bank, generally speaking, that's going to be tax deductible. But this 5% rate that you're going to pay the IRS is not tax deductible. So it's a little higher than what it might seem. But again, 5% isn't the end of the world, if you're not sure of your income. If you remember, we talked about this, I think, on April 13th, earlier in the year, that once you don't make your payment by the due date of the return, April 15th, then the IRS starts charging you an extra 0.5% a month. But up until that time, right now, in this time period, if we're talking 2018, it's a 5% interest rate. So it's not huge.
Okay.
The other thing to keep in mind is this is, we're talking about federal interest rates. Your states have different rules. In Illinois, the states charge you about a 10% rate per quarter, actually. So it's quite significant. So, definitely would want to make sure you understand what the rules for your states are. They have generally different rules. But for federal, it's 5%. It is due Monday, the 17th.
Okay.
The other news, just yesterday in the tax world, there's been still a lot of activity. You might have seen some things. It's called Tax Reform 2.0. You've seen this possibly just yesterday, the House Ways and Means Committee, which is similar to the Senate Finance Committee, but it's the committee that first looks at these tax bills. They did just pass out of committee 3 different tax bills. So we're not done yet. But the thing we're hearing here is that the biggest thing that's in these bills is that they would make these tax cuts permanent for individuals. You might remember, Casey, that like the 199A rules, or they end the year 2025 is the last year for those. So they sunset, or different terms, they expire. This tax reform 2.0 is trying to make these permanent. It did pass out of committee along party lines, but I don't know of anyone who actually thinks this is going to pass the Senate. The Senate is much tighter. So there's a lot of talk about tax reform 2.0, but no one believes it's actually going to get enacted. So mostly it's kind of being ignored right now by CPA practitioners like myself, because we have enough to worry about. But you will see some articles, I'm sure, today. Just yesterday, again, it passed out of committee, and I think the House will vote on here by the end of the month, and it probably will pass the House. But it's apparently not going to go any further than that. So that's just the way politics works, I guess.
So what would be the benefit of them not passing? Why would they not want to have that provision in there?
Well, it's budgetary. I mean, so it's going to cost. There was a $1.5 trillion cap on tax reform, that was how the thing even got passed, and you only need 51 votes in the Senate, and it was passed under what's called reconciliation. So it was 1.5 trillion cap. Now, what we're hearing is if you make these permanent, it's like it adds an extra like $600 billion. So it's just budgetary. It would cost a lot more over this 10-year window. So that it's just that if certain people think, well, if we do have to cost the government some money, right, it could increase growth, and ultimately we'll be better off. And there's others that think, we can't afford another $600 billion, right, when we're already in debt. So, but again, it looks like the House will pass it. It's just it's not gonna pass the Senate.
Right. It's too bad. Okay.
Yeah, but that's 2026, so it's a little ways off.
We got a ways. Got a ways to think about it.
Yeah, and obviously with midterm elections, coming up in November, I mean, it's, everything, I'm reading is the House, the Republicans are definitely going to lose seats. So, so it could be a totally different ballgame next year, right, in the House. So.
Yeah. Well, that's pretty normal for the incumbent party to lose seats at the midterms elections. That's pretty common.
Yep.
Okay.
Yep.
Anything else out there we should know about today, Glenn?
I don't think so.
Okay.
Yeah, just quick reminder, farmers don't have to make a third quarter estimate. They can make that fourth quarter estimate January 15th. But, other businesses, you do have that third quarter estimate coming up on Monday. So.
Right on. All right, Glenn. Well, if guys would like to learn more about some tax options they might have or some issues that they may be dealing with and they want to talk to somebody about that, how would they do that?
Yeah, best to call me here at our office at Heinold Banwards. It's 309-694-4251, or you can look me up on Twitter at Glen Birnbaum.
Right on, Glenn. Okay, Glenn. Well, you have a good week, and until next time, we'll talk to you then.
All right, Casey. Appreciate it. Thanks.
Thanks, man.